Hello guys, welcome back to our YouTube channel. We are here to study. I'm Stabza Tabsoranti. It's our day 3 today. Still discussing companies. We are here to study Mona Repokeleza Distinction Effect. Okay guys, in our previous video, which it was day 2, we discussed different transactions regarding ordinary share capital, on how we record our ledger account of ordinary share capital, whereby we spoke about inflows and outflows of money in our company. So today's lesson, it's all about transactions and ledger accounts of companies. We are still continuing, as I have said that in this day 3 we are going to talk about retained income. Okay guys, the study outcomes for the day. After engaging with this study unit, you will be able to differentiate different transactions unique to companies, record different transactions to ledger account, and use different methods to calculate your amount. Okay. So today the main lesson is all about retained income, the ledger account of retained income. What is a retained income? Retained income account is prepared because of the buybacks and the repurchase of shares in the company, and we use it to record the accumulated portion of a business profit that are not distributed as dividends to shareholders, but instead are reserved for reinvestment back into the business. Normally, these funds are used for working capital and fixed assets purchases, capital expenditure, or allotted for payment of debt obligations. So guys, retained income, guys, is the same as capital account, but it's different. We cannot classify it as a capital account, but we can classify it under owner's equity, whereby on the credit side increases, on the debit side decreases. We prepare retained income at the end of the day because of we repurchased or we bought back shares back in the company. That's why we have retained income at the end of the day. Okay guys, as we have classified our retained income is classified under owner's equity. On the credit side, it's a positive amount whereby it increases. On the debit side, negative amount, it decreases. So in the credit side, it's an inflow, debit side, outflow of cash. Okay, and then retained income, on the credit side we increase, debit side it decrease. Credit side, inflow of money, debit side, outflow of money. Okay guys, we are still using our steps. Always, like, you must think about your steps when you open up your ledger account. First step, your opening balance. In our previous video we spoke about our opening balance, our first step. So you must make sure that you have your opening balance. So when it comes to retained income, they won't give you too many transactions regarding the opening balance. They will just give you an amount. It will be given, the opening amount, it will be given as usual. So the transaction, it may say, at the 1st of January 2020, the following balances appeared as following. Retained income, 874,000. You just take that 874,000 and then you go to your credit side. We open our books on the credit side, guys. It's a retained income, owner's equity, increase on the credit side, decrease on the debit side. We just take our amount, we open it on our credit side, we record your date. Do not forget your date, guys. On our first, the beginning of our financial year, which is 1st January 2020, we have our balance brought down. Which is 874,000. We just record it as it is, guys. So you must not worry. First step, opening balance, as always. 874,000 is the amount we retain on our previous year. That's why we say it's balance brought down. It's balance brought down because of we retained it from our previous year. So we are going to use this amount to open our new ledger account, to open our books, okay, for this current financial year. Am I clear? I hope so. And then guys, step 2. In our previous video, we spoke about ordinary share capital, in which we say our first tool is issuing of shares. We are selling our shares to public. But when it comes to retained income, we are no longer selling, but now we are retaining, guys. So step 2 is a repurchase of shares after buying back our shares. That's whereby we spoke about average price. So now, you may look on your ordinary share capital. We have our ledger account there, whereby we have our opening balance 3,150,000 on the 1st of June, and then on the 1st of March we decided to issue out our shares to public, and then it was recorded as bank CRJ, cash receipt journal, because we received money 100,000, and then there was a repurchase of shares on our debit side, which on the 1st of June, which is bank CPJ, the outflow of money in our business, which it was 45,600. We used our average price, whereby we said your amount of shares divided with your units of shares, you get your average price, which it was 76 cents. No, now they say the transaction says 60,000 ordinary shares were purchased from a shareholder on the 1st June 2020. The company paid R3.50 per share. Now we have our average price. What are you going to do? You're going to say R3.50 minus your average price, minus your 76 cents, equals to your R2.74. So that R2.74 is the amount we are going to use to calculate the amount for the retained income. So we are going to say 60,000 shares multiplied by the retained income, which is R2.74, and then we are going to get how much? 164,400 at the end of the day. That amount, which is 164,000, is going to be recorded on the debit side of the retained income, of our retained income. That money, we retained it from the repurchase of shares. It's not, it doesn't belong to the company, but it's going to be used for those expenditures, such as maybe electricity, maybe we adding assets, because of we didn't use our market price to do what? To repurchase shares, but we used what? Our average price. Sometimes there are different transactions. They will give you different transactions. Maybe they will say 60,000 shares were repurchased on the 1st of June above the average price, meaning that they will say above the market price, meaning that our market price here is R3.50. Above the market price, maybe it will be R4. So it's above the market price. So you must go back and make sure that you get your average price. Do not record anything without having your average price. We use our average price to calculate our retained income. So now guys, we have our opening balance on our credit side as our inflow of cash, and then we have our outflow of money in our debit side as retained from repurchasing of shares for the company. Okay, and then guys, our full retained income account, debit and credit. On the credit side, we have our opening balance 1st of June 2020, 874,000, and then we have appropriate account, which is GJ, general. Appropriate account, we will discuss it further in our day 4. We are going to discuss it further. For now, you must only know how to follow your steps. And then we have our second step, which is buybacks, which is CPJ, cash payment journals, is regarded as bank. Whenever we purchase something, the money goes out from our bank account. That's why we say it's bank. And then guys, from our previous video, you learned on how to close off your account. You cannot open the account and then at the end of the day, you don't close it. You must open, at the end of the day, you must close. After recording your opening balance and the repurchase of shares, we have our appropriate account, which is general journal, and then we close off by having what? By having balance carried down at the end of the day, and then we transfer our balance carried down as balance brought down as our closing off. That amount, that highlighted amount there, XX, is going to be our new opening balance in the next financial year, guys. And then, guys, what is very important is the note, guys. You cannot prepare a note without knowing your ledger account. First, we start on our ledger account, and then we go to our note, guys. So we have retained income note, in which we are going to use it to record where to our financial statement, such as balance sheet. So it's a straightforward procedure. You must know your skeleton, guys. We say it's a skeleton, you must know your skeleton. At the beginning, you have the balance at the beginning. After balance at the beginning, you have your net profit after income tax. Not before, but after income tax. You generated money. After generated money, you subtract your income tax, and then you have net profit after income tax, which it belongs to the business. And then we have repurchase of shares. We no longer using the average price, but we are using the difference that we retained from subtracting our market price with our average price. And then we have ordinary share dividends. In our note, we have ordinary share dividends. How do we share our profits to our shareholders as a company? How do we distribute our profits? We have interim, in which in the middle of our financial year, we issue out interims to our dividends, and then we have final dividends or declared. We declare them at the end of the financial year. We pay our shareholders, and then we have balance at the end. Okay, guys. Balance at the beginning on the 1st January 2020. It was given as how much? 874,000. And then we have transactions there. Let's read our transaction. On the 1st January 2020, the business has an authorized share capital of 6 million shares. 70% of the shares were in issue on the 1st January. Transaction belongs to ordinary share capital, but not retained income. That's why we say at the end of this lesson, you must be able to differentiate all types of transaction. This transaction belongs to ordinary share capital, but not retained income, but it might be useful at the end of the day. And then, second transaction, the business decided to issue more 50,000 units of shares to the public for R2 per share. That transaction belongs to owners, to ordinary share capital, because of we are issuing out shares to the public. It doesn't belong to retained income, but it may be useful at the end of the day. And then, third transaction, 60,000 ordinary shares were repurchased. Because of that, we repurchased. We are not issuing, but we are repurchasing, meaning that we can use this transaction in our retained income. Were repurchased from a shareholder on the 1st June 2020. The company paid $3.50 per share. That's why we used our average price, and then we calculated our difference when we say our market price subtract our average price, and then that difference we are going to use it, and then we are going to take our 60,000 units of shares, multiply by that difference, and then you're going to get your amount of shares that we are retaining back to the company. Okay, and then we have interim. They will say interim dividends are as follows: 630,000. It's given right away. Sometimes they may use percentages. That interim, it was calculated as 60%. But for now, it's given. You just take your interim, you record it there on your retained income note under ordinary share capital as how much? 630,000. Now here's the trickiest part. We are declaring. Now we are distributing final dividends to our shareholders. The transaction says a final dividend of 22 cents per share was declared on the 28th December 2020. Only shares in the share register qualify for final dividend. Only shares in the share register qualify. That's why I'm saying it's very important to know your date. When did we distribute our final dividends? At the end of the financial year, which is 28 December 2020. So let's see which shares do qualify for final dividends. We go back to our ordinary share capital. On the 1st of January, our shareholders, we did not declare, we did not distribute final dividend, so it qualifies. And then on the 1st of March, we decided to issue more shares to the public. We did not distribute our final dividends, meaning that they qualify. And then we decided to repurchase again on the 1st of June. It's not December yet, meaning that they qualify. So you're going to say your units at the beginning, which it was 4,200,000 plus your issue units, which is 100,000, subtract your repurchase of shares, which is 60. And then at the end of the day, you will have how many shares? You will have how many shares? 4,250,000 shares at the end of the day. Okay, and then guys, you're gonna take those amount of shares after adding your balance and issued shares, subtract your repurchase. You're gonna take those shares and then you're gonna multiply it by 22 cents. Yeah, the shares we have is 4,190,000 multiplied by our 22 cents. And then the amount that qualifies, the amount that we are going to distribute at the end of our financial year for our shareholders, it will be how much? 921,800. They qualify. Sometimes they may not qualify, meaning that we paid our shareholders before buying back or before issuing shares. So they will tell you they qualify or they do not qualify. So you must always think about your date. At the beginning, did we issue final dividends before opening our ledger account, before issuing out our shares, or before repurchasing? That's where you must hold it. So you must always consider your date. We are working with dates here. Once you forget your date, everything is wrong. So make sure you know your date when it comes to this part, guys. It's very important, guys. Go and study your dates, your financial year. Sometimes they may tell you that the financial year, it's beginning on the 1st of June. So when does it end? On July. The next month is your ending of the financial year. Our financial year starts at February. It ends when? March. You see, guys. So January, December. After December is January. Our financial year starts again. And then December, it ends. So you must always remember your dates. Always consider your dates, guys, when it comes to this part. And then, guys, we have dividends on ordinary share capital versus retained income. How do we record? We have our ledger account for dividends on ordinary share. We have our ledger account. Okay, guys, that ledger account, it only shows dividends for interim, dividends for final. So before you take your amount and record it in your note to balance sheet, you must first start with your ledger account. We have debit and credit. On the credit side, it will always be appropriate account. It will always be appropriate account. And then on the debit side, we are going to have interim and final, meaning that the money goes out of the business. It's regarded as an owner's equity account. So the money goes out of the business. It's outflow of money in the business. And then you're gonna add your interim 630,000 plus your 921,800,000, and then you're gonna get how much? 1,551,800. That 1,551,000, you must balance your equation. What happens to your left side, it must happen to your right hand side. So our debit will be 1,551,800, and your credit side, it must be 1,551,800. And then that appropriate account, we are going to use that amount in the appropriate account, ledger account of the appropriate. So we're gonna talk we're going to discuss appropriate account in our day 4. And then after having that amount, which is 1,551,800, you're going to take that amount and put it inside a bracket. The money is going out of the business. So in accounting, we use bracket to show that it's an outflow of money. It's regarded as an expense. You use bracket. If you don't use bracket, you're gonna get wrong, guys. You won't get a mark. So always consider your bracket. You must show us, no, this money is an outcome of money in the business. So, and then we have our opening balance for retained income plus our net profit, subtract our repurchase of shares because of that bracket, and then subtract ordinary share dividends, bracket, and then at the end of the day we have our balance at the end, which is balance brought down, balance carried down. We are going to use this amount again when we open our note to balance sheet of retained income, or whenever we open our retained income ledger account. Okay. And then guys, please make sure you go through this, you find some papers, maybe past exam papers, and then you study it again. We spoke about ordinary share capital, we spoke about retained income, and then dividend on ordinary share capital, and then on how to do our ordinary share note, which is note number 7, and then our retained income note, which is note number 8, and then how do we post them to our balance sheet, our financial statement. And then we did ordinary share capital, which is interim and final. So guys, you may go back again, look into this video, and then write notes that you understand. Yeah, and then that's all. So our next session, we are going to talk about income tax and appropriate account. Like, yeah, we are going to get into deep stuff now, guys. So be with me, subscribe, comment if ever you have any questions. Follow my social media platforms if ever you have any questions. Have a nice day. Thank you.